Imagine this for a second. Geopolitical chaos in the Middle East right now, with the Iran tension spiking oil prices all the way to the upside. Inflation refused to die down completely, as experts have been expecting record high valuations screaming bubbles, with recession odd jumping all the way to the upside as well. The Buffett indicator is flashing a huge warning right now. Yet, here we are in 2026 May. The S&P 500 has hit a fresh new all-time high within 7,300 and 7,400, and the Nasdaq is also smashing all the way to the upside. Not only that, Dow Jones is also pumping all the way with higher numbers. All of this, everyone is asking one simple question: why is it that the market has not crashed yet? The doomsayers have been calling this for years, that the market is going to crash, but what we see right now is that the market keep moving all the way to the upside. In this video, I am pulling back the curtain on the real structural reason why the market have exercised and exhibited this very bullish resilience all the way to the upside. The hidden force that has turned it into a very strong resilience bull that is surprisingly hard to break. I will also tell you why we also need to focus on this very year 2026 and 2027, because we might see a crash or a huge correction. And I'll also share with you what smart investors are doing right now. This will be one of the most important videos you've watched on the market and investing this very year. Stick around. If you like videos like this, please don't forget to leave a like for this video, subscribe, and turn on the bell notification for more videos like this. Let's start with the setup and why a crash could have happened. There are obvious risks that a lot of persons are not paying attention to in 2026. We have an ongoing crisis in the Middle East that is affecting oil prices and the entire energy market. High debt level, mixed Fed signal. Investors could not really decipher whether Fed is going to keep rates unchanged or they're going to cut rate. All of this reason is very, very important. Extreme concentration on a handful of AI giants. And the last risk that is piling up right now is that the Buffett indicator is in a fire territory right now because it's over 200%. And historically, this kind of setup precedes a painful correction. What that means is investors are watching this Buffett indicator closely, because if it corrects, the market is going to have a great impact, and the correction is going to be very, very huge. Amidst all of these piling reasons, the market shelved this off and keep climbing all the way to the upside. And this is the most powerful reason behind this. It is a system that has been built over the decade by the United States. Now, I'm going to share with you 5 interconnecting pillars why the markets keep pumping all the way to the upside, increasing with resilience bulls in this very market. Pillar 1 is the $49 trillion pension machine. We are talking about the American retirement saving. As out of late 2025, the retirement asset hit about $49 trillion, not billion, trillion dollars. A massive chunk of household wealth, 401ks, IRAs, millions of Americans automatically contribute their everyday paycheck, and this money must flow in month after month regardless of the headline, what you are seeing on Fox News, CNN, BBC, and all of those. And when prices dips, it buy more shares. Of course, we know that turnover is tiny because it is locked away for decades. What all of this does is that it creates a constant demand, a built-in buy pressure that does not panic sell. What this means is that for every dip we see in the market, there is this buy pressure that comes in to scoop that up and make the market moving all the way to the upside. It is like a shock absorber, the size of an entire global economy. Aside the United States of America, no other country in the world has anything like this scale that it is tied directly to the stock market. The second pillar why the market has not crashed yet is the corporate buyback, what I call the $1 trillion machine. Companies are now buying their own stock like never before. What we are seeing right now in the market has never happened before. We have a lot of documents that proves that the markets have been moving all the way to the upside as a result of the fact that companies are now buying their own stock like never before. We see that in the S&P 500 companies spent over $1 trillion on buyback recently in a record time. In 2026, a lower borrowing cost from the Fed cut that we saw a few months ago. This machine is rolling all the way to the upside, and I don't think it will pause anytime soon. We know one thing for sure, that buybacks reduce share count, boost EPS even though the profits stay very flat, and directly support prices. Tech giant is already leading the charge, but it is widespread right now. Goldman Sachs and others have noted that these have been a huge driver of returns. It is corporate America voting with a balance sheet. We believe our stock is undervalued, or at least worth supporting. This creates a relentless upward bias, and this keeps the market moving all the way to the upside with relentless bullish move. The third pillar why the market has not crashed yet is what I call the Fed put and the liquidity backstop. There is an invisible safety net, and that is the Federal Reserve. Investors have learned over 40 years that the Fed won't let the system implode. What that means is that rate cut, liquidity injection, the Fed put this even in 2026 with mixed signal, and the central bank has shifted towards a supporting stability stand right now. We've seen recent time from Jerome Powell talking about Fed buying more American bonds. What that means is that they are actually investing in American bonds. They are buying back, they are injecting liquidity into the economy, and this always make the economy to stabilize, thereby making people to buy more, because when you have a lower interest rate, it makes people to borrow, and after they borrow, they can invest in other assets, which stock is not an exception. One of the most important thing about this backstop is that a little pullback to the downside from sellers get absorbed very, very quickly, because liquidity is now flowing into the market from the Fed, because people are now borrowing at a very lower cost, or at a slighter lower cost or interest rate. As we all know right now, the interest rates have been reduced about 3 times. The fourth pillar why the market has not crashed yet and keep this bullish resilience is what I call the global capital and dollar dominance. We have to understand one thing, and that is US is still the world's safe haven. People talk about China, people talk about a lot of countries out there, but we know for sure that the US is still dominating. They are still the superpower. No one have taken it from them. Until that happens, US is still the safe haven, and when there is a global uncertainty, what happens is that capital flow into dollar assets, and this make the US stock move all the way to the upside. Not only that, commodities move upward as well with it, and we've seen this. One thing very important is that overseas investors bought massively into US securities, which make the market move all the way to the upside. The dollar reserve status right now is approximately 57% of global reserve. What that means is that trillions seek dollars and US stock and bonds. What that means is institutions dominate over everything, and they hold for a long time and don't panic sell. So if you see any little dip in the market, any seller that panic sell, they buy back, and the market keep pushing all the way to the upside. The fifth reason why the market have not crashed yet, even in 2026, is what I call the index fund passive investing and self-renewal. Let me explain what that means in a second. Index itself evolves, and a lot of investors don't know this, but smart investors do. The S&P 500 is not static. It kicks out losers every year and add winners, like AI leaders, passive index fund and ETFs now own huge chunk of the market, creating an automatic buy inflow. What that means is it automatically makes the market keep moving all the way to the upside despite the little correction we see in the market. Add AI optimism and then strong earning. Big tech especially beating estimation. People estimate this number is going to come out for their earnings, but it will outweigh that number, making it more positive, making investors have strong confidence, and the market keep pushing all the way to the upside. This is very important for the market because it serves as a shock absorber, making the market to move all the way to the upside automatically. Here is one thing very important. Overlaying these 5 pillars, the AI investment boom and tech giants, massive capex in data centers, chips and infrastructure, we see massive earning growth that remains solid despite everything we are seeing right now in the Middle East and the Iran tension. The market is not ignoring the risks yet. It is betting high on AI productivity and also the earning that outpace them all over. But now, this is one of the most important things you must pay attention to, the risks, which is what I want to talk about right now. Here is the truth. This support makes a prolonged 2008 style collapse less unlikely. But one thing very important is that they don't eliminate the correction. We can see a sharp correction or a little bear market all the way to the downside. The concentration of risks right now is very high. AI hype versus the actual return. Right now, a lot of people don't understand that the hype we are seeing in the AI sector and data center infrastructure and also semiconductor is so high than the actual returns. This means you need to be very careful. Not only that, another risk that you need to pay attention to is geopolitical escalation, especially the one we are seeing in the Middle East. Policy mistake. This is also a huge factor. Policy mistake maybe from policymaker in Washington or from the new Fed chairman. Another most important risk that people are not paying attention to, but I believe smart investors do, is what I called buyback fatigue, which can trigger a 20% drop all the way downward. That means that correction can be very severe and it can happen in a very short time, because when we have buyback fatigue, this is a very serious condition in the market that a lot of newbie or retail traders don't actually pay attention to. This is a risk you must have to pay attention to while the market keep moving all the way to the upside. And lastly, we know that things don't go up forever. Nothing goes all the way to the upside forever. We must have to see correction at one point in the market, and you need to expect this and plan your way all the way to the upside so that when that correction comes into the market, you have been planning for the correction before it actually happens. That is the way smart investors think. So what is the move you are taking right now? You keep investing with a plan, or you wait for the market to crash and then you buy the dip. You are diversifying, or you are focusing on quality stocks and commodities right now. Drop your comments in the comment section. And do you think that we might see a crash this very year 2026 or probably 2027? Drop it in the comments below. If you like this very content, don't forget to leave a like for this video, subscribe if you have not, and turn on the bell notification for many more videos. Thanks for watching, and I will see you in the next video.